Nice to meet you, everybody. And today we continue capital structure decisions, but we would like to introduce new concepts which fix new motivations behind those types of capital structure decisions. And today we are going to discuss how information asymmetry matters for capital structure choice, agency problem, and some new trends in capital structure decisions in corporate finance. We have plenty of questions, as always, to be discussed within the class. And the first one, we need to understand why information asymmetry can matter for these types of decisions. And what does it mean, the order of financing? Or sometimes it's called pecking order of financing sources. Then, of course, as always, when we introduce some conception, we need to understand how we can verify whether it really holds for actual companies in real life. So that's why our next point of the discussion would be concentrated on the methods of verification or tests for signaling motives behind the order of financing. And then I would like to introduce additional very interesting point of view, which is called in corporate finance window of opportunity framework for financing decisions of the companies. Then we will switch to the agency cost, agency problem, and try to discuss whether agency problem can matter for capital structure decisions and all the choices here. And finally, because we already talked in the first class that knowledge companies, or the so-called living firms, they really differ from traditional companies, which really were very, very important and very, very standard for the industrial economy. But with the knowledge economy, with this big challenge of knowledge economy to the business, the living firms are really very different because they mostly compete with the non-financial resources. That's why the problem arises where the capital structure decisions for these very different companies called knowledge firm or the living firms really differs from previous times. And finally, again, I would like to summarize whether financing leverage is a magic tool for many companies or even for every company in the business. So that's why I'm going to discuss with you so-called zero debt event or zero debt phenomenon of capital structure decisions for some companies. And then, of course, we make a summary for the whole topic because it was really long and huge. So our first point of discussion, the order of financing. What does it mean? The pecking order of financing has been introduced by Steve Myers, and it still is under discussion in corporate finance. So what does it mean for the company? It means that the company would like to be really very flexible in financing decisions. And that's why when it comes to decide which particular type of capital should be attracted, debt or equity, the company first will prefer internal sources of financing, which mean accumulated, retained profits in the business. And then, if they are not sufficient for investing policy, it will then go to the external sources of financing. But first, the company must switch to the debt capital in case the company has some deficit of financing. And only after debt capital issues, the company will again switch to the equity sources of financing if still that is not sufficient to finance all the projects. So it means that retained earnings are the first and prior source of financing. And it means that now we are not speaking in terms of the finding right balance between the marginal cost of debt and the marginal benefits of debt. And the second point in that slide also shows that the tax shields which represent the benefits of the debt are not the priority argument anymore in the capital structure decisions. At first, the company will try to use internal sources and only then go externally to debt financing. And of course, when going to debt capital, the company will first try to find lower risk debt financing, which is collateral backed, which has a collateral. And then, if it's not sufficient, then the company will switch to the so-called subordinated debt, which is more risky and which will provide the higher rate of expected return, the higher cost of debt. And if this is not still enough, not still sufficient, then the company will go into new stock issue as a last resort to find the sources of financing for investing policy. To summarize, the equity is the last resort according to the pecking order of financing approach. Unless debt becomes impossible, only after debt becomes impossible, the company will think about equity issues. And it means, of course, that the debt capacity of the company becomes also important argument for the decision making. So what we need to continue and how we are going to continue now. What is behind, which arguments, which motivations are behind this type of order of financing? First, we would like to discuss with you that in the real actual capital market, in actual real life, in actual real business, there is information asymmetry. It's the information about the company is not distributed evenly. There is some type of information which is not available for external investors, which is really available only for the management team of the company. And it means that without specific signals, information signals, investors cannot identify the quality of the company. They cannot accurately differentiate between so-called good and bad firms. What are good firms? Good firms are expected to generate large and sustainable free cash flows in the nearest future. Next point is really very important. Managers are, of course, risk averse, and they don't want to go into bankruptcy and financial distress with the company, with the firm. They are behaving themselves rationally when making the decisions. So the rational managers will try to transfer only good signals, of course. So then, for the bad companies which doesn't have nice perspectives to generate large and sustainable free cash flows, the management cannot send good signals without cost, because always there could be a cost after this wrong signal. So they cannot imitate good signal if these companies are not good. They don't have really the prospective projects to generate positive free cash flows. And then finally, according to that conception, the bad signal will be really costly, and it could become even stronger in terms of the cost than the good signal in terms of the impact over the company. To continue, we would like also to introduce very important next argument. At times of information asymmetry, when investors cannot get enough information, and the manager, they do have that enough information about the company, they can judge accurately about the perspectives of the company, the managers will really have very strong incentive to issue equity, new equity, only at times when the current market price for stock is really very, very close or even above intrinsic true value. So there is very strong incentive to pick up additional proceeds with the equity issue at times when the current market price is really above true value of the stock. At that period, equity becomes relatively inexpensive, relatively to the period when it's priced correctly, when the price is equal to the true value. And it will mean that there would be lower expected rate of return as a compensation for the risk for investors. So the managers are really incentivized to issue equity only when equity is currently priced above true value. It will become inexpensive, that's the first argument, and they will collect more money because the price is above true value. But if they do this way, then the adverse selection as a problem can arise. Adverse selection means that in that period of time, equity issue is not a very sweet product for investors who are willing to buy, because they can also perceive that managers are trying to make this additional equity issue because the stock is overpriced. Next, it's very important. If stock at some period in time is priced below the intrinsic value, then it provides relatively expensive financing. So that's why managers, of course, do not want to go into the new equity issue at times when the current market price is already below true or fundamental value of the business. So to finalize, we need to say this adverse selection argument means if there is a deficit because the internal funds are not sufficient to finance all the investment projects which are really efficient, then managers will prefer debt to equity. But because they have substantial information, very important information, private information, which is not spread over between investors. But then the argument about adverse selection becomes very important. So how about the information content of debt to equity choice? If debt to equity coefficient is really fixed, then good firms will have lower probability for financial distress. And the new debt issue will become really good signal because it will convey the information about this huge generating capacity of positive free cash flows in the future. But how about the new equity at that period in time? If debt to equity is still fixed and the managers are trying to decide to issue new equity, investors may assume this adverse selection. And then equity will become the good signal only if the current price reflects true value of a company. Of course, management team is really reluctant to issue equity when the shares are undervalued. We already explained it. And then we need to summarize. In the pecking order of financing, this information asymmetry plus adverse selection problem becomes very important arguments. The motivation is not to be involved into adverse selection because there would be negative reaction of investors and the company cannot collect enough money to finance all the projects. And even underinvestment problem may appear in some particular firms. Nice to meet you, everybody. And today we continue capital structure decisions, but we would like to introduce new concepts which fix new motivations behind those types of capital structure decisions. And today we are going to discuss how information asymmetry matters for capital structure choice, agency problem, and some new trends in capital structure decisions in corporate finance. We have plenty of questions, as always, to be discussed within the class. And the first one, we need to understand why information asymmetry can matter for these types of decisions. And what does it mean, the order of financing? Or sometimes it's called pecking order of financing sources. Then, of course, as always, when we introduce some conception, we need to understand how we can verify whether it really holds for actual companies in real life. So that's why our next point of the discussion would be concentrated on the methods of verification or tests for signaling motives behind the order of financing. And then I would like to introduce additional very interesting point of view, which is called in corporate finance window of opportunity framework for financing decisions of the companies. Then we will switch to the agency cost, agency problem, and try to discuss whether agency problem can matter for capital structure decisions and all the choices here. And finally, because we already talked in the first class that knowledge companies, or the so-called living firms, they really differ from traditional companies, which really were very, very important and very, very standard for the industrial economy. But with the knowledge economy, with this big challenge of knowledge economy to the business, the living firms are really very different because they mostly compete with the non-financial resources. That's why the problem arises where the capital structure decisions for these very different companies called knowledge firm or the living firms really differs from previous times. And finally, again, I would like to summarize whether financing leverage is a magic tool for many companies or even for every company in the business. So that's why I'm going to discuss with you so-called zero debt event or zero debt phenomenon of capital structure decisions for some companies. And then, of course, we make a summary for the whole topic because it was really long and huge. So our first point of discussion, the order of financing. What does it mean? The pecking order of financing has been introduced by Stu Myers, and it still is under discussion in corporate finance. So what does it mean for the company? It means that the company would like to be really very flexible in financing decisions. And that's why when it comes to decide which particular type of capital should be attracted, debt or equity, the company first will prefer internal sources of financing, which mean accumulated, retained profits in the business. And then, if they are not sufficient for investing policy, it will then go to the external sources of financing. But first, the company must switch to the debt capital in case the company has some deficit of financing. And only after debt capital issues, the company will again switch to the equity sources of financing if still that is not sufficient to finance all the projects. So it means that retained earnings are the first and prior source of financing. And it means that now we are not speaking in terms of the finding right balance between the marginal cost of debt and the marginal benefits of debt. And the second point in that slide also shows that the tax shields which represent the benefits of the debt are not the priority argument anymore in the capital structure decisions. At first, the company will try to use internal sources and only then go externally to debt financing. And of course, when going to debt capital, the company will first try to find lower risk debt financing, which is collateral backed, which has a collateral. And then, if it's not sufficient, then the company will switch to the so-called subordinated debt, which is more risky and which will provide the higher rate of expected return, the higher cost of debt. And if this is not still enough, not still sufficient, then the company will go into new stock issue as a last resort to find the sources of financing for investing policy. To summarize, the equity is the last resort according to the pecking order of financing approach. Unless debt becomes impossible, only after debt becomes impossible, the company will think about equity issues. And it means, of course, that the debt capacity of the company becomes also important argument for the decision making. So what we need to continue and how we are going to continue now. What is behind, which arguments, which motivations are behind this type of order of financing? First, we would like to discuss with you that in the real actual capital market, in actual real life, in actual real business, there is information asymmetry. It's the information about the company is not distributed evenly. There is some type of information which is not available for external investors, which is really available only for the management team of the company. And it means that without specific signals, information signals, investors cannot identify the quality of the company. They cannot accurately differentiate between so-called good and bad firms. What are good firms? Good firms are expected to generate large and sustainable free cash flows in the nearest future. Next point is really very important. Managers are, of course, risk averse, and they don't want to go into bankruptcy and financial distress with the company, with the firm. They are behaving themselves rationally when making the decisions. So the rational managers will try to transfer only good signals, of course. So then, for the bad companies which doesn't have nice perspectives to generate large and sustainable free cash flows, the management cannot send good signals without cost, because always there could be a cost after this wrong signal. So they cannot imitate good signal if these companies are not good. They don't have really the perspective projects to generate positive free cash flows. And then finally, according to that conception, the bad signal will be really costly, and it could become even stronger in terms of the cost than the good signal in terms of the impact over the company. To continue, we would like also to introduce very important next argument. At times of information asymmetry, when investors cannot get enough information, and the manager, they do have that enough information about the company, they can judge accurately about the perspectives of the company, the managers will really have very strong incentive to issue equity, new equity, only at times when the current market price for stock is really very, very close or even above intrinsic true value. So there is very strong incentive to pick up additional proceeds with the equity issue at times when the current market price is really above true value of the stock. At that period, equity becomes relatively inexpensive, relatively to the period when it's priced correctly, when the price is equal to the true value. And it will mean that there would be lower expected rate of return as a compensation for the risk for investors. So the managers are really incentivized to issue equity only when equity is currently priced above true value. It will become inexpensive, that's the first argument, and they will collect more money because the price is above true value. But if they do this way, then the adverse selection as a problem can arise. Adverse selection means that in that period of time, equity issue is not a very sweet product for investors who are willing to buy, because they can also perceive that managers are trying to make this additional equity issue because the stock is overpriced. Next, it's very important. If stock at some period in time is priced below the intrinsic value, then it provides relatively expensive financing. So that's why managers, of course, do not want to go into the new equity issue at times when the current market price is already below true or fundamental value of the business. So to finalize, we need to say this adverse selection argument means if there is a deficit because the internal funds are not sufficient to finance all the investment projects which are really efficient, then managers will prefer debt to equity. But because they have substantial information, very important information, private information, which is not spread over between investors. But then the argument about adverse selection becomes very important. So how about the information content of debt to equity choice? If debt to equity coefficient is really fixed, then good firms will have lower probability for financial distress. And the new debt issue will become really good signal because it will convey the information about this huge generating capacity of positive free cash flows in the future. But how about the new equity at that period in time? If debt to equity is still fixed and the managers are trying to decide to issue new equity, investors may assume this adverse selection. And then equity will become the good signal only if the current price, reflects true value of a company. Of course, management team is really reluctant to issue equity when the shares are undervalued. We already explained it. And then we need to summarize. In the pecking order of financing, this information asymmetry plus adverse selection problem becomes very important arguments. The motivation is not to be involved in the adverse selection because there would be negative reaction of investors and the company cannot collect enough money to finance all the projects. And even underinvestment problem may appear in some particular firms. Let's also discuss how we can measure information asymmetry and apply additional technique to understand whether this particular conception of capital structure holds. What could be the proxies for information asymmetry once again? Many researchers, to understand whether pecking order holds, will apply so-called event studies. What is an event? We can say that if the company is announcing the equity issue, this is really very important, really very sound event. And then the market, the investors, they should react. So depending on the perception of the investors about the perspectives of the company, the reaction could be positive or it could be negative. Next, how we can approximate the level of information asymmetry if we want to compare different companies in the sample when we are applying event studies. And we would like to understand whether the reaction of investors could be different for similar events about the equity issues, depending on the level of information asymmetry. I already mentioned that in papers, when you need to understand the information asymmetry, how much is this asymmetry, or maybe it's not as big as we can think about it, we at first will look at some analytical agencies, those who follow the company. We then will look what they are producing as analytical products. Do they have really dispersion in their estimates between the analytical agencies for the same particular company? The higher the volatility in their forecasts, in their judgments about the company, the higher the information asymmetry, because those are analytics. They are carefully collecting all the news, all the data. They are carefully watching for the business. But something is wrong with this information. It's not purely consistent. So that's why the forecasts can really differ, and there could be high volatility in the profits they are forecasting for some future. Then we can collect the sample according to these particular indicators, these proxies of information asymmetry, trying to maybe divide it into two subsamples, saying those companies are they really have high level of information asymmetry. The residual part of the sample may have lower level of information asymmetry, so on and so forth. Next step, then the researcher should compute so-called normal rates of return with the specific models of asset pricing. Again, those of you who will join us in degree program, you will go with us through the specific course which will show how it works in research, how we can apply it for some new data of your countries you are interested in. But now I'm not going into technical details. If you've got that normal expected rate of return for all the companies in your sample, now the logical step would be, let's compare the actual rates of return on the stock of the companies included into the sample with this normal rate of return. I'm not discussing particular ways how you're going to compute the normal rates of return. There are few of them, but in any case, you will get your normal rate of return. And then comparing it to the actual rate of return, you will compute these deviations of the prices from the normal rates of return within some period of time. Then if you summarize, if you add them up, all these deviations, you will get so-called cumulative abnormal return. Why it's called abnormal? Because you are comparing the actual to the normal one. It could be higher or it could be lower than normal rate of return. In both cases, it would be called abnormal because it's not strictly equal to the normal rate of return. Imagine if you are an investor and you do think that that stock issue is something really positive for the company. You don't think this is adverse selection of the managers. You don't think that the stock issue is a type of a lemon but not a sweet fruit. Then your reaction would be positive. And these cumulative abnormal returns, the changes, the deviations summarized for the period will be above zero. But on the contrary, if you do think the managers, they announce this additional equity issue just at period when stock is already overpriced, then this is adverse selection argument behind the decision of the management team. And this is a lemon, but not a sweet fruit. So then the reaction is going to be negative of the investors. And the cumulative abnormal returns may become below zero or negative. So that particular approach, which is called event studies, it's really important to compute cumulative abnormal returns and then try to understand the overall reaction, positive or negative. Continuing the technique, then it would be applied to a particular sample, and you need to understand whether these abnormal returns are really statistically significant. Again, I'm not going into technical details, but what we would like to discuss better. At first, we need to understand that when researchers are focused on a so-called short-term reaction or almost immediate reaction for a few days after the announcement, after the event, on average, all these reactions are in most cases negative. And it will mean that investors think the announcement arrived at the market when the current market prices per shares of this particular firm were already or above the true or fundamental value. But if we try to differentiate between companies with higher growth opportunities and companies with lower growth opportunities, then we will apply the coefficient which is called market-to-book ratio. In the first lecture devoted to the capital structure decision, I explained you this is a type of a determinant market-to-book ratio, which is a proxy for the growth opportunity. So, and in many papers, researchers will come to the conclusion that almost no negative reaction at the announcement day will follow the announcement about the equity issues if the company has higher than average growth opportunities. On the contrary, if the company has lower than average growth opportunities, the negative reaction will happen, and it could be really, really strong. Next very important point in the papers which are focused on the immediate or short-term reaction of investors. If the negative reaction occurs, then it means the investors are not willing to buy that stock at that particular current price. They would like the discounts to the market price. And the level of discounts will become even bigger. The discounts will increase after several days after the announcement, after the event arrived to the market. So many researchers will conclude investors really thought stock were overvalued. It was a lemon, and it was adverse selection motivation behind the decisions of management teams. Next, also very interesting, if we compare the reaction after the announcement for all types of securities of some particular companies, including debt securities and, of course, equity of different types, then we can understand that there is a different reaction to different issues. So, the first, it's really very important when we are talking about the common stock issue, the reaction would be first negative, and second, it would be really strongly negative. It would be significant. It would have very high discounts from the market price. It will mean that investors again think that the company is already overpriced, and managers want them to buy that lemon. And analysts will think that analysts which are following that particular firm, they may think that if managers made a decision just at that period of time to make that particular announcement and to go into the new equity issue, maybe those managers, because they have private information, are not very much optimistic about the perspectives of the upside trend to the market price. So they already think the stock is overpriced, because remember, if the stock is overpriced, then the expected rate of return is lower, then the cost of equity financing is lower, as compared to the opposite situation when the stock is underpriced. So the first argument, managers would like, of course, lower cost of financing. And it happens if the stock is overpriced. But if they think the price even can become higher than now, then maybe they have to wait. But if they didn't wait and they announced just now the new equity issue, they are not very optimistic about the future perspective to upside in the stock price. Again, these particular observations and empirical research are consistent with the adverse selection problem. Next, we already talked about common equity issues, and we already said there is a negative reaction of investors. But what is also interesting, there is a relationship between the amount of equity issue, about the sum of money the company is announcing, and the negative reaction and the quality of that negative reaction, I would say. So the larger the equity issue which is announced, the more negative is this effect on the investor side. Next, how about the debt issues? How about the reaction of investors for the prices of debt securities? In case the company is issuing straight or traditional or just standard debt in terms of, let's say, corporate bonds, it would be the least negative reaction, if any. Many researchers will even not find any negative reaction. In case the company is issuing so-called convertible debt or convertible bonds, which has already built-in equity-like component, because at some period in time it would be converted into a company's common stock, voting stock, again there could be negative reaction observed of investors. And finally, what we would like to conclude here, again, if we are looking through the papers which are trying to compare the level of the negative reaction after the event, after the announcement, how the company is going to finance the business according to this logic of pecking order of financing, we see different reaction, mostly negative for equity in all cases, mostly non-negative in the case of debt securities, which mean that, again, adverse selection motivation is behind the decisions of managers. To summarize, the higher the asymmetry of information, the deeper is the decrease in the stock prices. In case of high growth opportunities, the reaction of the market is going to be much smoother. It's not as huge. And the weaker reaction of the investors will come in case if we are looking at the companies which are now at their growth stage of the life cycles. But again and again, we would like to conclude that the reaction is based on the information asymmetry. Information asymmetry is generating the motivation, which is titled adverse selection problem or adverse selection argument of management team. So we are moving forward, and I would like to introduce a very original and really disputable approach, which is called windows of opportunity, which means we would like to understand the answer to the question, does current market trends and conditions matter for the capital structure and decisions? At first, I would like to summarize what we already made. In the previous class, we discussed that some companies, when making financing decision, will be really focused on the understanding the balance between marginal costs and marginal benefits of debt. Then we already discussed a few minutes ago the pecking order of financing, which is not focused on the balance between costs and benefits of debt financing, which simply assumes that if company doesn't have enough internal funds, it's better to go into debt. And only after debt is expired and you have now constrained in your debt capacity, then please go and issue equity. This is totally different motivation for the managers. And we said the managers in this case, they have to understand the level of information asymmetry, and they have to understand that any decision would be like a signal to the market. And we show that the reaction of the market, of course, is not very simplistic. It will depend on the debt capacity. It will depend on the growth opportunities of any company. It will depend on the different types of the securities that company may issue. What is going to be discussed just now? What is called windows of opportunity. This is like a bombshell. This is something very, very different to both theories, to trade-off and to pecking order of financing. Pretends to be really very different. What does it mean? It says, just make your life much simpler, because in terms of the financing decision, just look at the market, just open the window outside of company, look at the market. If you have the positive trends for equity shares in the market, maybe it's reasonable to follow these positive trends, which will mean that the firm and the managers should pick up the trends in the capital market. They should be aware that this is not occasional trend. This is something more or less sustainable for some period of time. And if they see that now the stock issues are really very trendy in the market, it means the stock prices are high and they are growing, and investors really are attracted by the growing stock prices, then just go and prepare the new issue of your company stock. Think. You do not think in terms of the information asymmetry and signals. You do not think whether it's last resort or it's priority source of financing. You are just looking at the trends, and if the trend is really upward for the equity prices, then just go and prepare new equity issue. What if is going to happen if the trend in the market when you open that window is really opposite? It may happen that the equity shares are now priced much lower, and there is a downward trend in the equity pricing. But new bond issue then may come at place, and you will think in terms of debt financing. So, windows of opportunity, why it's so different? Because it is not related directly to the motivation to send some signal to the market. It is not related to the motivation to balance between marginal costs and marginal benefits of debt. It is not even related to the debt capacity, but it is related to the outside trends in the market. So it should explain the capital structure decision by some external factors in the market, but not by the internal, very specific factors of that particular company. And of course, after these types of papers appeared, we need also to say that the empirical evidence should be also a type of a controversial evidence. The authors of the paper about this window of opportunity conception, Baker-Ugler, they found empirically that this timing effect, or the desire to time the trends in the market and follow these trends in the market, this timing effect not only just exists, but this is a long-lived effect. In their sample, they found that after these equity issues, when there was upward trend in the market, the companies do not increase their financial leverage. The financial leverage, the coefficient debt to equity, stayed almost fixed for many years, almost for a decade. That's why they are trying to make a conclusion saying, well, the timing effect was dominating argument about the financing decision. And after they captured that positive trend in the market, they didn't change financial leverage. So the change in financial leverage was almost due to this upward trend for the equity shares in the market. On the contrary, there are some other papers which also are trying to verify whether this timing effect really holds. And they do confirm the timing effect exists, but in their samples, which they collected for some other periods in time, they cannot just confirm that this effect exists for a long period of time. On the contrary, they are saying it largely, in most cases, this effect disappears just after a few years, which means after a few years, the financial leverage would be changed. It may increase and the company will issue debt. So the timing effect can exist, but maybe for a much shorter period in time than it was observed in the original paper which introduced this window of opportunity conception. Next, there are also very interesting aspects of that discussion. Some authors, they found that the timing effect is related also to the level of asymmetry. And they showed that companies with the low information asymmetry, say with the high analyst coverage, those companies, they will have lower incentives to time the market. So their decision how they are going to change debt to equity coefficient or financial leverage of the company is not directly related to these break-even events in the market, which means the new trend in the market appear. So their decisions are not argumented by the reason just to time to catch up the trend in the market for the companies with the low information asymmetry. But how about the companies with the higher level of information asymmetry, which are not as much covered by financial analysts, and the investors still do not have really huge information flows about those companies, and investors do not have sufficient analysts' reviews and analysts' judgments about these types of companies. The researchers show that the timing effect is more or less relevant for these companies with the higher information asymmetry, but they do not apply that particular argument each time when the positive trend really exists in the market for the equity issues. So their new equity issues are really rare, not very often, but each time when they are going into the new equity issue, their issues are really large. And now we are introducing even new argument for the capital structure choices. In the previous steps, we by definition ignored the agency conflicts which can exist in many firms in real life. And now we would like to discuss whether this agency conflict can become some specific argument for particular choice of capital structure policy. At first, I would like to make very important points and to remind you about the agency framework in corporate finance. I would like to remind first that, of course, managers, they are not the owners, and they will act in their own self-interests. They would like to capitalize their professional knowledge, and it will mean that they, of course, will be looking for some monetary welfare. They will look for some monetary wealth when capitalizing their professional skills. But as well, they will seek for some particular private benefits, which would be just the market salaries higher than on the market, the salaries that they are looking for, plus, in addition, so-called perks or even job security. So when making many decisions in the company, also financing decisions as well, the managers could be motivated to get higher private benefits or at least to keep those private benefits in their hands. Then in investing policy, it can mean so-called entrenching investments. It can mean that the project that they are trying to pursue in the company, they will adapt these projects and the assets and the technologies and the profile of the projects to their own professional skills. Why? Because in this case, their bargaining power as managers, professionals will increase versus the bargaining power of investors who are not professional people, who do not have very specialized skills to run the company. In case they have the increased bargaining power versus investors, and of course versus members of the board, then in this situation for them it would be to some extent easier to capture the perks, to capture job security in the company. So the private benefits may increase if bargaining power of managers also increases. I would like also to remind you, we already discussed it briefly, but again, of course, every manager will sign specific contract which is describing the duties, the functions, the roles, the performance indicators, and of course some stimulus and some punishments as well. So, but this contract is very difficult to write like a complete contract which can predetermine every situation that may happen in the company. It is very difficult to verify that contract and to monitor how it's implemented. So that's why the performance of managers, whether it fits fully to this contract which is already signed, whether the performance of managers really suitable for the contract and it follows the contract, to observe that performance, it will cost to do it. So there would be some monitoring cost that it's not very easy even to organize. And that's why we need to say, of course, managers may perceive that it's not easy 100% to observe their performance strictly compared to the contract. And it's not very easy to write this complete contract strictly following all possible situations in the business. And that's why managers, of course, they will understand that they have some freedom in their decision making. And of course, they would like the freedom to overinvest if this overinvestment can bring additional perks to the managers, if this overinvestment can bring an increase in bargaining power versus the board and the investors. But then it follows that managers will really prefer to operate at low leverages. Why? Again and again, what we are going to say following this agency problem. If we understand there would be these private benefits, then these private benefits will decrease the value of the firm. And that's why, following this agency argument, which now means if you have agency cost, the value of your company is lower than it could be. This agency cost should be treated nicely within the decisions of the boards. Then owners will make financing decisions in order to get the minimum of agency cost, to get them lower than they are now, to minimize these private benefits. So in a simple model implemented or introduced in corporate finance many years ago by Jensen Meckling, we can just describe the situation with the following. If managers are also owners of the firm, and there are no other investors in the firm, the controversy in their behavior will still appear. They will still behave as managers, and they will be looking for these perks, but the agency cost will be at minimum level. But if they need additional financing, and if they invite so-called outside equity investors, new shareholders, then managers, because they are not the unique and the single owners of the business now after outside shareholders appear, they will not bear all agency costs. They will share them with the new investors. But how about the outside equity holders, these new investors, when they're making their own decision whether to invest in that particular company, because they do understand there is agency cost in that particular business? They could be even irrelevant between what? Between their estimate that the value is lower because there are agency costs. And the situation when they enter the company, they can increase their monitoring over the managers, and they will be strictly monitoring the agency problem. But then it will again cost some money for the company, and there would be so-called monitoring costs. So the value with the agency cost is lower than the potential value of the business without agency cost. and the value without agency cost if you are monitoring them heavily, but with monitoring costs. So between them, investors which are outsiders now, when making the decision, can become irrelevant. So they can enter that particular business. But if they enter that particular business because they are relevant, the outside equity will then create additional agency costs because private benefits, they will still appear in the business. They will not be internalized. They will not be fixed. They may increase due to the impossibility to monitor 100% the performance of the business. And then in that case, the debt can become the very important device to get agency cost decreased. And with the debt financing, private benefits will be internalized. They will not increase because there would be a burden for the top managers. There would be less freedom to spend money. There would be less freedom for entrenched investment, remember, which would be concentrated on the managerial professional skills, which may give them additional bargaining power over investors and the members of the board. So then it follows, if the company has severe agency conflict and problem, high agency cost, it's better than the company then will be financing with the debt capital, because then agency cost could be really reduced. And going forward, we would say, but debt financing, if company applies debt financing for some period in time, then cost of financial distress will, of course, appear. And the cost of financial distress will push the company towards equity financing. But when it comes for that particular break-even point in capital structure decision, you now think that equity financing is preferable over the debt financing due to the financial distress probability for the company. But then you have to make your choice between the private placement of equity, private equity financing, or public placement of your equity shares. And then it says that the private equity, when you have very few investors, the limited number of new outside investors would be more effective for what? For reduction in agency cost, because those would be, in most cases, professional investors, maybe institutional investors. They will not be very much dispersed. And for them to organize better monitoring after they enter the company would be even easier. So, to summarize, if we bear in mind that agency argument, then we are going back to the free cash flow argumentation as well. Then when companies making financing decision, the major goal would be to avoid agency cost, which will mean to avoid improper use of free cash flows for some investment projects which are not of interest for shareholder value maximization, which will increase private benefits for managers, agents. Then that is a very good toolkit, very good financial approach. It will add the discipline inside the firm over the management team. Because now you cannot invest in non-efficient investments. Now you have to think hard about probable financial distress in the future. Now you have to be very accurate with the cash flows of the company. And then it follows that different companies can have different sensitivity to that particular approach for capital structure decisions based on the agency argumentation. Companies with high growth opportunities and with agency costs, they must have high debt ratios, because companies with high growth opportunities are very sensitive to the nature of investments they are going to do, because without these capital expenditures, they cannot capture all these nice growth opportunities from the market. Companies with low growth opportunities, they may have lower debt ratios. So this is really very important conclusion which we can derive from the agency argument. To summarize, debt financing can reduce agency cost. Outside equity can increase agency costs because these private benefits will not be internalized inside the company in case of outside equity. And because equity will assume that, of course, maybe you would like to pay dividends, but these are not interest expense. There is no obligation for the cash outflows in terms of dividend, in terms of payout to investors. So these controversial roles of agency cost of debt versus agency cost of outside equity will push forward to optimal capital structure decision again. So because there would be some break-even points again in the capital structure decisions. To some extent, a company should rely on debt to reduce agency cost. But again, there would be some point in debt to equity ratio, some break-even point. Beyond that break-even point, beyond that particular target or optimal capital structure, the cost of financial distress may appear. And then companies should switch to outside equity. But it cannot continue with the equity issues year by year, because outside equity will bring increased agency costs back to the company. So this is really very important, because we already discussed this target capital structure, optimal capital structure, derived from the trade-off conception. This is not trade-off, but there are additional benefits and additional costs. The benefits now are reduced agency costs. The additional costs are increased agency costs. So balancing between agency cost in case of debt and agency cost in case of outside equity, the company should again think in terms of target or optimal level of debt. In the last years, very interesting approaches to verify the agency argument when making capital structure choices appeared. And I cannot miss them, and I would like to introduce them for you as well. At first, I'm talking about the traditional approaches. How we can verify this agency motivation for financing decisions. It should be also based at first on so-called event studies. I already a few minutes ago explained you this event studies framework, and it is applicable, of course, here. If you try to collect the sample with the companies who already announced a particular approach to the financing decisions, then you will observe how the prices are going to change. At first, of course, prices for equity stock, which will summarize all the reactions of investors. And first, in many papers we can find that in case when company is involved into new debt issues, especially corporate bonds, almost risk-free, which means these are senior debt of the company. They will have some collateral, some collateralized assets, and the rates of return required by the investors would be lower as compared to some other corporate issues. There could be some positive reaction of equity shares if they feel in that particular company the problem of agency costs really severe, and there is not very well established monitoring mechanism inside the company over the managerial decisions. Next, if the company is issuing risky bonds, not risk-free or almost risk-free, but risky bonds, which may not have any collateral behind that corporate issue. Again, you can observe the price changes after that announcement. They may also be positive if that particular sample of companies is reflecting the agency conflicts inside these businesses. And even there are some papers which are trying to understand how the investors will react and the prices then for the equity stock will change after the announcements about so-called swaps operation, when equity is exchanged for debt and vice versa. Debt is exchanged for equity. In all these types of papers, researchers, of course, following the logic of event studies approach, will collect the data and apply cumulative abnormal returns. To summarize, if in that sample we just picked up the companies which really have agency cost problem, then in most cases the reaction for debt issues, the reaction of equity shares investors or equity holders would be positive. If it's not positive, maybe there is a problem with the sample. And then there is a question, how we can identify and compare the companies from the point of view of the level of agency cost or agency problem within these companies. In most situations, we can advise to look at their board's work, to understand the quality of board of directors work. Because remember, this is the board of directors who has to balance the different and even controversial interests between the managers, agents, and owners, principals. So now I would like to switch your attention just to that particular problem of the role of the boards monitoring when they need to monitor the agents' behavior and try to minimize agency costs. There are interesting approaches which appears just recently, like in last year Financial Management Association of United States annual meeting. In some papers which were presented at that conference, very interesting approaches appear. That slide, what does it show? Some researchers, they tried to understand how the shifts in the governance regulation in the country, which can impose some new impact, some new changes on the board's monitoring role in the company, how these shifts can impact the capital structure decisions. First, I would like again to go back to the very important point. Managers, they don't like high leverages if in that company agency costs are already high. Managers, they prefer decreased leverage and they do not want to go into the cost of financial distress, and they really want to protect their so-called undiversified human or professional capital. So they will dislike the pressures that the high leverage and financing by debt will induce over their decisions. So if the regulators in the national levels and the macro level in some country will introduce new legislation to strictly protect so-called outside directors, which are not the owners of that business and which are not the executives in that business. And these types of additional protection for the outside directors really are observed in the history of governance in many countries in the world. Sometimes it was related to the introduction of so-called limited liability of outside directors for the board's decisions in case something wrong will be with the company. The limited liability for the outside director who is not the owner and who is not the executive of that particular company will occur. And this is less dangerous for them to be involved into major decisions made by the board. But that can also bring some negative consequence in terms of the decreased power of monitoring. So because maybe it can weaken their motivation for that outside directors to strictly follow and monitor executive teams. If it happens, then the monitoring power of the board will be less strong than it was before the regulation. Not in every company, of course, but in some companies after that particular shift in the governance regulations. And if the agency problem still matters in that companies, it can have a pressure over financing decision, and it will lead to the situation that you need to increase your financial leverage to counterbalance potentially reduced director monitoring from the outside director's side. If it happens, then what we can observe? First, we can observe so-called substitution effect in debt composition. It's not only financial leverage, which may increase as a reaction of a company with severe agency costs to the consequences of these shifts in the overall national governance regulation. What is a substitution effect? What does it mean? You need to increase your leverage first because that will impose some constraints, some limitations on the private benefits of managers. And they will dislike, of course, that debt, as we said many times within this class, because they would like to have freedom in spending free cash flows for their perks. But the increase in financial leverage will prevent them from spending the free cash flows of the company for these private benefits. And then, second very important point, the substitution effect will mean that the company will not also increase financial leverage, but the company may switch the debt from publicly held, which are corporate bonds outstanding, to the direct bank monitoring, because the company will increase financial leverage going into new bank loan, but not public issue of corporate bonds. Bank monitoring is direct monitoring because bank will require lots of data and information from the company before signing the contract about the bank loan. And then if we can observe the negative relationship, which will mean after the reform, we will find that the bank loan will be increased into the overall debt composition in the capital structure of the company. It will mean that reacting to the increased board's independence, which is after the governance national reform and is related to the specific attitude towards outside directors and introduction of this limited liability to make their life less dangerous when making the decision. If we can find this negative relationship, it will say there is this substitution effect. The company is increasing the monitoring over the managers with the bank loan, feeling that maybe the monitoring ability of outside directors could be even weakened after the shift in the governance regulation on the national level. on opposite, there also could be complementary effect, which will mean that despite the reform, in many companies, they would like to go in two directions simultaneously. They will increase this debt financing, despite they will have that understanding that the monitoring ability is a little bit destroyed. So the disciplined insiders, they will tend to subject themselves to the periodic scrutiny from the bank debt, because they want to convey the information about their commitment to reduce agency costs, to reduce them and to get the value of the company increased. So what are the empirical findings which will be derived with this particular hypothesis? In 40 countries, within these steps of the reforms within almost 16 years, the ratio of the bank debt to total debt decreased significantly following the adoption of the board's reform. Additionally, we can also understand that there are some types of governance reform which are not obligatory, which can be said as comply or explain. So the company itself will make a decision whether it's going to follow some recommendations which are not obligatory, which are not compulsory on the national level. So in this particular situation, what we can observe is followed from this empirical data. At first, we may see the significant reduction in bank debt financing if company is complying, or company will follow the logic, comply or explain after the recommended reforms. Complying will means the company becomes less opaque, the company shows additional data in its annual reports, the company explains the behavior and all the consequences of the decisions of the boards and the management team. So then it says that complying and explaining, the company is trying to make the monitoring mechanism over the managers even stronger. Then that's why the bank debt may be reduced with its scrutiny over the management decision. It is also shown that can depend on the level of information asymmetry. And we can also say that the companies with really high level of information asymmetry, they are also reacting to this type of board's reform, but they are not reducing as much as some other companies the bank financing. It means that they need additional monitoring device, additional to the board, because they do not have a high level of information spread over about the companies. With the severe information problems, they will prefer to rely on bank debt financing as well. Now let's discuss how the companies which are called knowledge or living firms are making their capital structure decisions. It's a very new trend in corporate finance, and maybe there is not much papers, not much ideas about the knowledge companies' decision-making about financing. But I would like to focus your attention on the problem of intellectual capital. In our first topic, I showed you that the living company competes with the intellectual assets, with the intellectual resources, with the intellectual capital. But intellectual capital is provided by companies' stakeholders. So that's why it's really very important to make this relationship between stakeholders' approach and financing decisions. And a very big and very interesting point is here on that slide. So the quality and the nature and the future of the relationship with the stakeholders must impact or must be really influential for the capital structure decisions. This is a very new point. It's not trade-off, it's not pecking order, it's not windows of opportunity, and it doesn't deal with agency problem. We are talking about very new vision of capital structure decision making for the companies which are very sensitive to the stakeholders' attitude. So first, the stakeholders of the company, they really bet on long-term perspectives of the firm. And I'm talking today not about financial stakeholders, the investors and creditors of the company. I'm talking about non-financial stakeholders, but they are also very motivated in long-term relationship with the company, and that's why they are very sensitive to the long-term perspectives of the company. But then we can derive some hypothesis saying that if some company has very high financial leverage, then her clients will become really sensitive to the company capability to service the debt, to the coverage of the debt by company's cash flow, because the clients, they expect the quality of goods, and the quality of goods, of course, is costly. So the company should spend lots of its free cash flows to sustain and to maintain and even to modify and to increase the quality of goods in the future. And the clients, of course, are very much motivated to get more qualitative goods from that particular firm. The same is true for the suppliers. Suppliers cannot be indifferent to the high financial leverage of the company they cooperate with, because they need this client, they need this sustainability in their business, and they need that client for the long-term perspective. But the high debt means the high cash outflow to service the debt. And that's why the suppliers may assume at some point in time that the company will not be capable to service the debt accurately, and then there would be some higher risk for the relationship with the suppliers. So, how about the personnel, especially top professional workers and top professional management team of that particular company? May they still be irrelevant to the level of financial leverage? I don't think this way. They also must react, and they would be also sensible to this decision of the company. And I will show you in a few steps that even competitors of the company may and should react to the decision to get higher financial leverage for that particular living or knowledge firm. So, step by step, first very important point, stakeholders, they will bring so-called specific investments into the company, because stakeholders will develop the dynamic capabilities of the firm that I explained in the first class. The dynamic capability is the capability to create and to increase intellectual or organizational capital. Some researchers will just try to use these two terms, intellectual and organizational capital, as synonyms, as Zingales and Rayan in that paper did. In many cases, people will write about intellectual capital as composed of three different components: human capital, client capital, and organizational capital. For the purpose of our discussion of capital structure, we will use them like synonyms. So the next very important point: these specific investments are motivated by the remuneration policy for professional workers, highly qualified, and of course, for top executives. So for the company, it is very important that these specific skills will be developed further, and the new quality for the professional skills must appear within the business. Go back to the first class, please. Say, the intellectual or organizational capital, it is developed inside the business. You cannot buy it somewhere before production. It is developed within the production process of any knowledge firm. And then also it's very important to underline that the motivation of the top personnel of the company should depend on the length of the period when the company will have really growth opportunities. Because if the company has high growth opportunities, then it is more interesting for people working for that company to increase their qualifications. The internal environment of the company would be really favorable for that upgrade of professional skills. For the companies which have those growth opportunities, it becomes really too important. And we need also to move forward. So we can build, following that article written by Rayan and Zingales, we can build this new framework for capital structure decision making. At the starting point, we have knowledge or living firm. Then we have to assume there would be a new role of cost of financial distress. What is new? It means that if you have really high debt in your financing policy, at some point in time, you will incur the loss in your intellectual capital or organizational capital. Remember, it's really unique. You cannot imitate it. You cannot buy it like some standard goods before the production. You need to generate it inside the business. In case the company is very close to the situation called financial distress, the company loses many capabilities, and the environment inside the company is now not motivating those people to increase their knowledge and to produce very unique intellectual resources inside the business. And this is new stakeholders, non-financial stakeholders risk, when the company is losing the capability to generate intellectual resources inside or organizational capital inside. From that follows that for the living companies, for the living firm, the role of capital structure becomes crucial, becomes really critical. This is the new role of capital structure decision. What's new? Capital structure becomes now the tool to support the dynamic capabilities, the capabilities to create new intellectual resources within production, and to retain these non-financial stakeholders because they are specific investors bringing specific skills to the business. And that's why we now need to recognize and to understand and to study in the nearest future this new approach for the value creation by capital structure decisions in these types of companies. So, let's compare traditional approaches. When I'm talking about traditional, I would like just to say those that we already discussed within the previous class and the current class. And let's compare them to this new framework to understand better, deeper, what is really new. So within the traditional approach, trade-off, agency cost, pecking order of financing, or even windows of opportunity, they all were really focused on immediate cash flow needs of the business. And they were discussing the relationship between the debt holders and equity holders. How about the new framework, which is now emerging in corporate finance, still maybe not well written, not well searched, but it's really very important because the economy has changed and the nature of the firm has changed as well. So in this new framework, remember, the immediate needs and cash flows are not the key argument in capital structure decisions. I'm not saying that the company is now not taking into account the cash flows needs. Not, of course not. I'm not saying this. I would like to say this is not the prior factor anymore. Now, financing policy should be viewed as a device to achieve high performance of intellectual capital, to provide a comfortable environment for dynamic capabilities of the personnel within the business. So now we need to discuss, is it possible to verify that stakeholder framework or new stakeholder approach for capital structure decision-making in the companies? I'd like to show you the papers that I already found, and this is like emerging types of knowledge in corporate finance, but it's really important, and that's why I would like to discuss it with you anyway. Again, for the empirical verification, we need to find a specific sample of firms. It should be specific for stakeholder sensitivity to stakeholders' behavior for that particular companies. And then we'll look at capital structure decisions for that sample of companies. How we can find those types of companies really sensitive to the attitude from their non-financial stakeholders. Researchers will apply several proxies, several measures. They will focus their attention on the companies with the unique products or with the specialized products first. And to differentiate between the companies in terms of their uniqueness, they will apply several metrics. So let's say research and development expenditures compared to sales, or selling and general administrative expense, which always include marketing expense as well, compared to sales. So the higher these coefficients for some companies in the sample, the higher, the greater the uniqueness of the company, its products, and of course, customers of that particular companies. According to the stakeholder idea, to the stakeholder conception, these companies are really vulnerable to the stakeholder attitude, and with this unique production, unique products and specialized products, they must have lower financial leverage. They should escape high financial leverage. So if we found that particular sample, then what's also worth doing? We need to compare them to the same profile of companies in terms of the operations. Also, they will have unique products and specialized products, but they will be less levered. So the peer companies to which we are going to compare should have lower than the main sample leverage. And now we are trying to go to the next step. At first, we can understand whether financial leverage can have an impact on their relationship with the customer, so-called customer-driven costs. We can rely on a very interesting paper made by Opler and Titman. They looked for a 20 years period for the companies which were in the distressed industries. So they wanted to monitor, to watch their behavior and their performance in these distressed industries. At first, they monitor these two subsamples, the companies which have high financial leverage and the companies with less or lower financial leverage in the same distressed industries. And of course, it is also really interesting to watch them at periods of so-called industry downturns, when performance of all companies, of course, is going down. So if we follow that particular paper, what we can observe, they computed industry-adjusted sales growth rates and industry-adjusted equity stock returns, and compared by these two measures the subsample with the higher leverage to the subsample with the lower leverage. At first, at good times, just before industry downturns. And what we can observe first, we need to say the performance measured by these two metrics would be weaker, it really was weaker for the companies with the high financial leverage as compared to the operational peers at that good times. But after the downturns, what's going to happen? That's even more interesting. The sales growth rate dropped significantly, and this decline was 25 percentage points even higher for the companies with initial high financial leverage as compared to the peers in the same industries going through the same industry downturns. So the performance dropped for all companies for the two subsamples, but the decline in the performance was more profound, more sound for the companies which were initially with high financial leverage. And it even also was related to the level of the R&D expenses to sales. The higher R&D coefficient, R&D expenses to sales, the lower became the performance in terms of the sales growth and industry-adjusted stock returns. The reason is that maybe the investors that are buying that stock and the clients that are buying these goods, they do not believe that the company with the high financial leverage in the period of industry downturns, being already involved in the financially distressed industries, can survive nicely and can service and maintain the quality of their products. Additional aspects also very interesting. The relationship with the personnel. Of course, we may assume that if the company has too high financial leverage, being a living company, basing its competition on the dynamic capabilities, and that's why being really very sensitive to stakeholders' relationship, if that company still has very high financial leverage and even plans to increase financial leverage, top qualified personnel may just simply leave that particular business and try to find additional jobs in some other industries, in some other companies. But that's not the story about that slide. That slide is also very interesting. It describes the papers which studied how that situation with the high financial leverage in these companies with the unique products may affect the relationship with the personnel. And they came to the conclusion that the high financial leverage companies are trying to use to offset the impact, the potential influence of trade unions, and to decrease the bargaining power of the trade unions within the company. So the companies which had higher financial leverage as compared to others, we observed that they decreased the payments to the personnel. And this discipline power of that didn't permit to their trade unions to struggle against this particular decision. So it will also show us that, of course, employee-driven costs could be very sensitive to the decisions about the financial leverage in this particular types of businesses. Last but not the least, so-called dedicated assets. Remember, if you have a unique business, you are producing unique products, you have very unique customers. And that's why inside your company, you already have very specific equipment, you already have very specific human resources, you really will have very specific product lines, so on and so forth, because you want to be really very valuable supplier for your clients, and you really need to establish good relationship with your contracting parties. So even if the customer cannot directly induce the reduction of financial leverage, because this is the company's decision, but the company itself may prefer lower financial leverage just to convey its ability to maintain long-standing relationship with the contracting parties, with the customers and with the suppliers, because customers are expecting very specific products. Suppliers are selling a very specific customized raw materials and semi-finished products to that particular company for its production line. So there are papers which studied it empirically, this relationship, and they came to the conclusion that the companies with the lower financial leverage, they will prefer this lower financial leverage if they at least have their major customer, and at least they already have their major suppliers, which are also adjusted to the production of customized products. So from that follows, even from the point of view of dedicated assets, the existence of very specific investments in the company, which should be customized to provide a very unique goods to the clients and to establish very unusual, very unique relationship long-term with the suppliers of that particular company. Even in this case, the company is really vulnerable to the level of financial leverage. They will prefer lower financial leverage to maintain this long-term relationship with the suppliers and with the customers. Let's continue discussing how we can verify the stakeholders' framework and its potential impact over capital structure decisions. I already showed you some pieces of research which were related to the customer-driven costs, to the personnel-driven costs, and I would like to continue with the reaction of companies' competitors. So how about competitor-driven costs? Going back to the same paper written by Opler and Titman, this really very interesting paper, so it has also these potential aspects. Again, we are looking at the companies in distressed industries, but for that particular purpose of the research, it's better to select those industries which have high level of concentration inside the industry. Why? Because if the industry is really highly concentrated, there are very few competitors within the industry. And that's why they can much easier cooperate with each other if they want to become aggressive against some particular company. And we are looking now at the companies in terms of their financial leverage. And again, there would be strong difference within even these highly concentrated distressed industries. Many companies will have high financial leverage. Other companies will have lower financial leverage. And if your competitor, they have a lower financial leverage, they may establish new rules of the competition. And finally, you can observe empirically that the sales growth and even stock returns adjusted to the industry trends, remember, these are the metrics of that paper, industry-adjusted sales growth rate and industry-adjusted stock returns, they really declined at a higher rate for the companies with the high financial leverage than compared to the companies with the lower financial leverage. So it could be interpreted as a result of this predatory behavior of their competitors when they are trying to propose and to offer new pricing policy for the products and for the services they are delivering to the customers within that industry. But the company with the high debt burden cannot follow this strategy effectively because the company already had the sales revenue dropped. And if they change the prices to the lower levels for their product, then the sales revenue that they are going to lose is really very high. That's why their sales growth is slowing down and their stock returns are lower than the stock returns for the equity shares of their competitive companies in that industry. Next. Another paper written by Zingales also is focused on the competitor-driven costs, but in that particular case, it is looking at the results in terms of the market share of the company, whether the market share of those firms with the high financial leverage will diminish, will decrease when the competitors try to react to the financial burden of those companies. So, and the observation is that, of course, that affects the ability to compete because debt, other things being equal, is reducing ability to invest. And you need to service the debt. So you need to be very careful in selecting your investment projects. The companies, competing companies, the rivals, they do not have high financial leverage, so they are really more flexible in terms of their investment choices. But companies with the higher financial leverage, in most situations, will invest less aggressively. That's why, of course, again, the sales growth rate will be not as high as their peers will have, and it will even decrease. And finally, even the market position would be decreased. The market share in the product market will decrease. And it will mean that it's due to the deterioration of the relationship with the customers, because it can also show that some of the clients of the company with the high financial leverage, they just left. And they made the decision to change their supplier. So they are no more the clients of these companies with high financial leverage. So, or if the customer doesn't leave for another company, then the customer will demand, will even insist, and will even require the lower prices for the products. And then again, the market share of the company may become lower. So customer-driven costs here at that slide, in that describing that particular approach for the research, will lead to the loss of market share in the product market of the company. So and that's really significant result. And finally, to go back to the knowledge companies, to the living firms, which are very sensitive to this specific relationship with their competitors, with their companies, with their personnel, with all their non-financial stakeholders. In some interesting papers which appear recently, and they were presented in the very interesting high-level academic conferences even last year. So we can observe interesting conclusion that the companies which have innovation success, they will have reduced information asymmetry. And then if they have this reduced information asymmetry, Going back to the Peking-Oda logic, they maybe do not have strong need to send additional signal to the market with the help of the new debt issue or new bank loan, and they will have lower financial leverage. In this case, it's important to understand how the innovation success is going to be measured. And it could be measured with the number of patents, which of course certify the quality of innovative processes inside the companies. And of course, the patents will positively influence the fundamental or intrinsic value of any firm to outside investors. And the additional metrics could be patent citations. So how many citations per each patent the company already registered. The higher the proportion of citations per patent, the higher the innovation success of the companies. So in that important academic new trend in the research, it was established that innovation success, this is also a credible signal to the market about the quality of the company because it reflects and captures the perspective of the business. And it was also confirmed that those companies are trying to escape additional debt, and they will have greater propensity to issue equity instead of debt. But at the same time, they will have lower expected required return of investors because they already confirmed their quality by this innovation success. And that's why they will have lower cost of equity financing. Now I would like to discuss with you really very interesting phenomenon, so-called zero debt capital structure. And again, there is a question whether we really see the magic in financial leverage. So that part of our discussion is saying no. There are some types of companies which do not feel any magic in financial leverage at all. So what is this zero level debt puzzle? At first, few illustrations again from empirical research papers. You may see that even in United States, a very well-developed economy, there are many companies which are non-financial companies in non-financial sector, which will have zero debt in their capital structure, even they will not have short-term interest-bearing debt outstanding. So they live in their business and they go through their life cycle stages without any debt. Almost 32% of the companies within this period of observation also didn't have zero long-term debt outstanding. And only 22% of companies, they have just some financial leverage, which is really low, only 5% debt ratio, the debt to average assets ratio. So what are the reasons why they do not use debt in their financing within this really long-term period of time? What could be the reasons? At first, let's say a few words about particular interesting characteristics of this type of companies with zero debt capital structure. And researchers, they used to match two samples compared by the operational profiles companies, but very different in terms of their financing policies. Zero level debt companies and their peers matched to them by operational profile, but with the financial leverage. Those who have zero level of debt, surprisingly, they have higher market-to-book ratios, and they have higher profitability measured with the help of their financial statements. Almost 1/3 of those companies with no debt in capital structure, they pay dividends on a regular basis. And as compared to some other companies with financial leverage, they pay even higher amounts of cash in dividends. Those companies are not really very young. In most cases, they are closer to the maturity stage in their life cycle. If we try to explain the non-existence of the debt in their capital structure looking at their balance sheet, if we try to explain it by lease agreement or so-called pension plans, which pension plans, so this is like a deferred debt of the company in front of their personnel, deferred money, they will pay them out. It's like an obligation of the company, but still it cannot be explained by existence of this particular relationship. In many situations, those companies which do not have debt in their capital structure, we can observe that the chief executive officer, the top guys, they will have ownership in that particular business, and even the ownership proportion would be higher as compared to their peer companies with financial leverage. In many situations, this would be so-called family companies. And within this period of observation, you see that even within 5-year periods, almost 1/3 of companies didn't raise any debt, but they continued investing, and therefore they funded their investment project by equity. Let's try to understand now what does it mean, this situation when some companies continue maintaining zero leverage capital structure. What could be their motives behind that very original decision? We can explain it at least by the trade-off theory of capital structure we studied in a previous class. Can we explain it by some financial constraints or by some conservative policy of these companies? Maybe this decision is due to some particular very specific investing policies of these companies, or maybe macroeconomic trends were really very influential, and that's why maybe this windows of opportunity approach, if applied, can explain that they didn't want to time the market when debt prices were increasing, or maybe some other reasons behind. So let's go into some details. To some extent, yes, maybe we can explain this type of very original behavior by the trade-off conception. And then it will mean that at least in some years, the marginal benefits of debt financing got just equal to the marginal costs of financial distress. And that's why they were not looking for additional debt. And they didn't increase their financial leverage, and they didn't want additional debt. Or maybe we can just explain it by very high cost of adjustment to the target capital structure. But this is like only for few companies that can be explained by this framework of trade-off conception. When we are looking forward to the financial constraints or the conservatism in their financing policy, we may find different papers which can really confirm that that could be the reason. For family companies, because they don't want their income to have this burden in the near future, and they really want to secure that income for their successors in the nearest future without any burden. But this is the specific psychology of this family-managed and family-owned firms. In some cases, this could be companies with the lack of reputation in the debt market. They really don't have credit history, and they still didn't want to enter in this financing choice and to have some debt in capital structure. In some situations prior to the International Financial Reporting Standards changes, when lease agreements were off-balance sheet financing, they were treated as off-balance sheet, not among the liabilities. They could explain to some extent the non-existence of interest-bearing debt in the balance sheet of the company, but they used heavily the leasing agreement. But after the changes in the International Financial Reporting Standards, when a leasing agreement, even not only finance lease but also operating lease, should be disclosed in the balance sheet, it's no more an explanation. So how about the investment decisions? Maybe they are looking for this zero leverage, accumulating their good reputation among the investors, and accumulating money, not paying them out for potential debt before high, very huge or really abnormal investments. This type of hypothesis was also explored in some papers, and in some of those papers it was confirmed. And of course, macroeconomic trends also can matter, especially in terms of the window of opportunity suggestions. So these are the periods when there were some overvalued stocks and undervalued stocks, and the companies would like to benefit from the periods of these changes in under and overvaluation of other stocks. So this is just the end of that class, and before I finish, I would like to give some concluding comments based on the opinions of the business experts, not only empirical researchers as I showed before. So it means that this is not like a strict empirical paper based on the econometrical technique. Those are the researches which are based on the questionnaires or surveys distributed among chief finance officers of many companies. At that particular slide, as you see, we can observe the questionnaire distributed by very well-known in academia, academic corporate finance authors. But the answers to that particular survey are really very meaningful and really very interesting. So we can see that the companies are assigning great value to the financial flexibility. And that's why they do not want debt burden in many situations in their financial structure, especially for dividend-paying companies. So the CFOs of this particular type of companies who really assign great value to the financial flexibility, they are explaining in their answers to the surveys that they do not want this burden to be imposed over their decisions, because they need to continue paying even large dividends in cash out to the investors of the company. In many cases, the responses also will suggest that the company, if it's undervalued, then the CFO will be really reluctant to issue new equity, because we already explained that only in case when the stock is overvalued, then the expected rate of return would be lower. In the opposite case, the expected rate of return or the cost of equity financing becomes higher. When it comes to the trade-off argumentation, when we were talking about the tax shields, the people who are practical experts in business, they think about these tax shields, but they don't think this is a very, very important argument. It has moderate importance in their decision-making. What they are really concerned about is their credit rating. They didn't want their credit rating to become lower. They want to keep their credit ratings, and that's why they want to escape the increase in financial leverage. Otherwise, the credit rating may drop. And they also have their concerns about earnings volatility. And in case the volatility of earnings is really high, or above average, or above the level of their competitive companies, they will try to escape debt financing as well. But you see very interesting answers to the question whether you think in terms of the target leverage or some optimal level of your financial leverage. Almost 50% of the respondents gave the answer that they really set up the target leverage, and they do understand the adjustment costs, and they really try to follow how the target leverage is going to change in the nearest future and how they should adjust to the target leverage accurately. Somehow about 1/3 of the respondents, they answered that they really think about target leverage, but it's more flexible than fixed. And about 20% of the respondents, they said that maybe they ignore the problem of the target level of the leverage. This was the story about the mode of thinking of CFOs in American business. How about the European firms? If we look through that particular slide, we can just immediately compare the answers of Americans to the answers of the CFOs in European business. For them as well, financial flexibility may be the most important driver behind capital structure decision. For them also, it's really important to understand at least the target capital structure of their companies and try to adjust to that target capital structure and bear it in mind when developing financing policy of the business. They also have some priorities over the flexibility, credit rating, earning volatility, the same as their American colleagues in the same positions of CFO. Let's summarize the major so-called stylized facts on the aggregate or national level. I would like to point out first that over a long period in time, aggregate financial leverage in the economy is really stable, is really stationary. So this persistence of leverage can be explained by different arguments. Next, it's a very important point also, even within past 50 years, that aggregate level of financial leverage, when you are computing financial leverage with the market value of equity in your denominator, then it's about 32%, and it's kept stable on the national level. At the aggregate level, when you look how the capital expenditures changes and how the level of your financial leverage changes, then you will see that capital expenditures very close to the changes in internal funds. But it's not really true to small publicly traded companies. But when you see this financing deficit or the lack of your internal funds on the aggregate level is really comparable year by year to the new additional debt or new debt issues. So, and that say that on the aggregate level, the pecking order of financing looks like sustainable or looks like it holds for many companies within a long period of time on the aggregate macro level, but not for some particular samples of companies within particular industries. And it's not the same for the small public companies. And you see for the small public companies, the 0.4 and 0.5 in that slide, they are always different. So their level of capital expenditure are not comparable to their internal funds, and their increase in that financing is not comparable to the changes in the level of their financing deficits. What they are doing, those small public companies, how they are financing on the aggregate data on that level, it more or less seems that they are financing their investments by new equity issues. So I would like also to mention that this is an open part of our course, Corporate Finance, which belongs to the new program at Coursera, degree program, Master of Business Analytics. And for those who join us at a degree program, we'll continue discussing capital structure of financing decisions of the company. And of course, some other decisions there will be also discussed. But when we are discussing our financing decisions in the course for degree program students, we would like to expand our understanding of the motivation of managerial behavior behind financing decision making. First, I would like to introduce the irrational behavior of the managers. Up to that point in our discussion, we assume managers are always rational. They are carefully looking at the risk-return trade-off. But maybe it's not the case in real life. And maybe their normal behavior or their behavioral anomalies or, let's say, behavioral biases also can matter for financing decisions when they do not make the decisions on the basis of rationality. What is going to happen? Does it impact financing decision? Does it exist in actual real life practice? So I would like to show and to share with you that type of discussion. The behavioral biases may be really very different. The most well-known or well-studied, deeply studied among them is so-called overconfidence or overconfident CEO. Overconfidence of the CEO. Is it a good news for the business and for the investors? Is it always good news at least? Or maybe it's not a good news at all, because this is a big difference. The CEO which is confident and the CEO which is overconfident. Being confident, you behave yourself in a rational manner. But overconfidence, this is a term which picks up the behavioral bias anomaly. And that is really interesting. So these behavioral additions will follow in the degree course, financing decision, investing decision, and the payout decision as well, and also the strategic deals, mergers, acquisitions, leverage buyouts, so on. Extension number 2, we would like to start discussing in the class number 1, when I introduced you the course, and it was an introductory topic. I already mentioned this is a very important trend now in the globe. Regenerative economy, the nature of economy is changing, the criteria for success are changing, and the value of growth, it becomes very important. Should every economy grow just at any cost, at the expense of environment, at the expense of some social problems and social inequality, or the policy on the macro level should be changed? So if we think this way, then the next question would be, how about the finance? What are financial concepts? Do they contradict those which are traditional approaches in finance to these new requirements, new pressures from environmental, social, and governance issues in the globe? So the regenerative finance, the framework and its potential impact over financing decisions, we can also discuss in degree program. What is sustainable finance? In our degree program, you will see the course Sustainable Finance. It's really big proportion of our knowledge that we want to deliver to our degree students. What could be the combination of these new financial instruments which are called sustainable financial instruments. What is the relationship between them and the expected rates of return on debt and expected rates of return on equity financing in the companies which apply sustainable finance approach. So I invite you, of course, to join us to the degree program. And at that point of our conversation, I will say that we already done in terms of the capital structure decisions for the open part of the course. See you later in the next open topics. And of course, I will highly appreciate to meet you in our degree program, Master of Business Analytics.